Hi, everyone. This is Jason Bjork of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's been a hedge fund manager for over 2 decades at Baring Asset Management. He also, in the last couple of years, he launched a paid investment newsletter for retail investors at a very affordable price. It's focused on dividend growth and contrarian value investment companies in out-of-favor sectors. Kevin Duffy of Baring Asset Management and the Coffee Can Portfolio. Thank you for joining me again.
Hi, Jason. Good to be with you again.
So, Kevin, we're recording this interview on Friday, March 21st, 2025. The gold price is still a little bit above $3,000 an ounce. The 10-year U.S. Treasury bond has stubbornly high. Maybe it's not so stubborn given the policies out of Washington, D.C. here. It's at 4.25%. You just did an interview in the last week or so for the market. I think it's either New Zealand or Germany. I'm trying to look at it in the market.nzz.
They're based out of Zurich, actually.
Okay. Oh, out of Switzerland. Okay.
Mm-hmm.
And so you're warning about the stock market, asset prices, and the global economy. So why don't you talk about your views right now, given the asset prices, the global economy, and the U.S. stock market?
Okay. Well, I see it as we've kind of had two peaks. One was in early 2021. That was the COVID kind of blow off peak, and we had the meme stock speculation, growth, profitless growth at any price, Kathy Wood's ARK Invest bubble. And that was also coincided with the inauguration of Biden. And it was very much, I thought, kind of a left-wing bubble. That was another aspect of that. In between, we had big plunge in the bond market in 2022, also took stocks down, and we've since recovered. And now I think we're in this peaking of a second bubble, a little bit more of a right-wing bubble. You've got the Trump inauguration. And if we go back to that last bubble in 2021, the total market cap, if you just look at the Wilshire 5000, was about 200% of GDP. We got down as low as about 135%. We then came right back to 200%. So I see, the problems. We're all, Jason, we're very much aware of the debt problems in this country. I think a lot of this goes back to the Trump administration and the over-the-top reaction to COVID. In his last year of his first term, government spending went up 20%. The Fed's balance sheet grew about 80%. We now are sitting at, public debt to GDP is 122%. It was, I believe, under 100% before COVID. So we've got all these issues. And then I think when Trump was elected, there was a certain amount of exuberance that he was just going to kind of come in on the white horse and save the day. And now I think the markets are starting to sense that this is not going to go all that smoothly. And I think that the tariffs were another big issue that were downplayed. And Trump has really promoted the tariffs. I mean, that has been kind of the center of his economic policy. And the markets are having a tough time with this. At the same time, we have price inflation has been stubbornly high, and interest rates have been stubbornly high, and all these things have kind of come together and have made it tough this year on investors. And we're seeing kind of a reversal of a lot of the themes that we saw play out over the last couple of years.
Do you think the stock market right now is kind of having a temper tantrum because Trump was promising the tax cuts, but Congress is not giving in? Congress wanted to actually keep spending more. So they were talking about reducing spending with Doge, but pretty much Congress seemed to want to sneak in all this extra spending, and they haven't passed the tax cuts. Do you think that we're going to see a huge temper tantrum in the form of a stock market correction if the promised tax cuts do not pass in?
Yeah, I think I think the tax cuts. I think we've got to have definitely a cut in government spending. I mean, the problem is the debt and the deficits and interest rates. All these three things at the same time. Um, I went back over some statistics here, and let's see if I can find these. The so so the problem is the interest payments. When Trump took office the first time, total interest outlays were 14% of tax receipts. Today they're 23%. And if you look at all the debt that's got to reset, it's going to go up to 28, maybe 30% of tax receipts. This is the problem. So what has to happen? I mean, we're running 6 to 7% of GDP deficits, and I know that
is that a lot higher than normal? So is that like higher than World War II? Like you just say 6 to 7. I don't know relative to what exactly is it way above normal?
well, I know that yes, it's way above average, and I know that what Scott Bessent wants to bring. His goal is to bring those down to 3%. And the feeling is that if they can get to 3%, that maybe they can, maybe stave off bankruptcy. Now, those deficits did go as high as I think 15% of GDP during the big stimulus with COVID, but that was very much an outlier. But no, I think 2 or 3% of GDP has been a little bit more normal. But of course, when you're running debt, when you have this level of debt and dysfunctionality, these deficits are they're definitely a problem.
So do you think then that the tariffs, I know you've studied Austrian School of Economics. Do you think then what type of damage do tariffs historically do to the economy, and why does the Austrian School hate tariffs?
Yeah, I think first of all, it's not just the Austrian school. It's pretty much all schools of economics are against tariffs. I think even the Keynesians are against tariffs. Even Paul Krugman is against them. So most economy, there are a lot of bad economists out there. Most of them are sound on tariffs. I don't even think the American people are really all that gung ho about tariffs. I'm not sure that outside of Donald Trump and his close associates like Howard Lutnick, I don't think there are too many people that really are too crazy about tariffs. The problem with tariffs, I think there are several things. One is trade is win-win. So, what you're doing is you're basically putting up a barrier on trade. You're taking the way that we create wealth as individuals is that we should be allowed to freely trade with others and improve our situation. We trade what we have for something that we want, and both sides are better off from it. So tariffs are basically hurting yourself. That's kind of just the first level of it. They're making you poorer. The second level of it is they're also hurting your neighbors. And so that's not really good from a foreign policy standpoint, because now that that interconnectedness that you really need, the interdependence that nations have, you start to break that down. And there's a saying, an old saying, where goods are not allowed to cross borders, armies will. So, there's another consequence of this, which is you are increasing your burden on defense spending by antagonizing your neighbors. And there are some other consequences as well. By hurting yourself, you're also the government is also expanding through this because of course war. Tariffs, as Howard as Warren Buffett said, they're basically acts of war. Okay, and so you start putting you war is the health of the state. You're expanding the state, but you're also impoverishing yourself. So how do you pay for it? You're going to run the printing press. So all these are consequences of tariffs. And we just talked about how Trump needs to reduce the size of government. I mean, that's the only way out of this mess. And tariffs expand the role of the state. He's going in exactly the wrong direction. I think that maybe markets are just barely starting to sniff this out.
Well, also the earnings are starting to disappoint, right? With the S&P 500, that a lot of these global multinationals are starting to say that higher inflation than expected. The Fed hasn't cut rates as much as some people would have hoped. And then you add in the tariffs, and the consumer is either not spending more, consumers are cutting back, or they've had to deal with inflation and higher credit card interest rate debt and other types of debt. So you add in all these factors, and with the stock market valuations, a lot of these companies are not reporting the profit margins and earnings growth that the market was expecting.
Right. Companies are starting to sense this, and you look at the big tech stocks, and they're vulnerable to what is going on with these tariffs. I mean, there are some companies that are more exposed than others. You look at, for example, Apple. Apple does, I think they get about 16% of their revenue in China, but more importantly, they're highly dependent on high-end manufacturing in China. Okay, so any kind of a trade war, I mean, it does two things. One is the Chinese, they're going to become more nationalistic. They're going to be more willing to buy their own brands and less of Apple. But the other thing is that Apple needs access to that high-end manufacturing. So I know Donald Trump wants to bring those jobs back to the United States, and Tim Cook, the last time Trump tried to do this, he said, the problem is this expertise. If you were in the United States, you might be able to fill a room with the people that have this kind of level of expertise. He said in China you could fill multiple football fields with that level. They just have such a deep level of talent there. Now so that was during the first term what Tim Cook said. This time he's basically telling Donald Trump what he wants to hear, which is, hey, we're going to invest $500 billion back in the United States. We're going to bring these jobs back and all the rest of it. Well, I mean, that just flies in the face of economic reality. And so this is all going to be very painful for Apple. The other thing is, so the cost of manufacturing is going to go up. They're going to be doing things far less efficiently. They're also, this is another thing that's happened as a result of the first trade war. It's funny how we're talking about the second trade war, but we've already got the results are in, as far as I'm concerned, on the first one, which was a total disaster. And you look at what's happened with China. China has largely de-risked as a result of the first trade war. They've largely de-risked. And they've also been, and not just the first trade war, but also the sanctions. That was in 2018. You had the 2019 sanctions against Huawei. They're one of their leading technology companies. And so, if it throws this, the Chinese were very willing to buy American technology. As a result of those sanctions, they have basically now had been looking at all this uncertainty, and it's really driven innovation in China. So China is now super competitive in terms of electric vehicles. They're super competitive in terms of smartphones. And, I think that this is hurting Tesla. I think they've got a lot more competition, and this was a lot of it was going to happen anyway over time. But I think Trump's actions in his first term was really the catalyst. And I think Apple is really getting hurt by this as well.
Okay, so I was going to ask you what you mean by de-risk, but it sounds like you're saying that there should be more free trade and less tariffs. So, like the classical economics, the theories, I agree with, but the reality is that like there actually isn't a lot of actual free trade that because a lot of these other countries put enormous tariffs. Like for example, like India with cars and motorcycles. Like if you want to buy a American car, American motorcycle in India, I think there was 100% tariff. Some insanely high tariff on stuff like that, and there's a ton of other examples like that. So like kind of free trade is kind of like a theory and a classical myth. And these other countries, what they have currency pegs, they play games, they put tariffs on goods, they ban some goods to protect domestic industries. So in theory, I agree with all free trade and free markets. It's just that in practicality, most of these governments and central banks just actually don't do it.
Okay, so no. I'm glad you brought this up because I hear this a lot. There's a book that James Bovard wrote back in the 90s, I think, called The Fair Trade Fraud. And I recommend it. Look, this game of protectionism has been going on for a long time. The argument that the Austrians make, and I think just about any economist, is that trade, if you are you want your people to be able to trade with as many people as possible. Okay, it's going to benefit them. Now, what other people decide to do is their business. If they don't want to trade, okay, that's fine. Just because they do something dumb and they shoot themselves in the foot doesn't mean you do the same thing. So the idea of free trade from an Austrian standpoint is very simple, unilateral. We engage in free trade. What you do is your business. If you want to hurt yourself, we're going to show you that free trade is in the best interest of our people and it's going to grow our economy the most. Now, the real world, okay? What you said is in theory. Well, it's in theory, it's correct, and I think in practice it's correct as well. The problem, as you point out, is that not everybody plays nicely, and countries will protect, industry A or industry B or whatever. Okay, well, that's again, I think that's their business. But we also have to understand that the United States does the same thing. Okay, it's not like we're a bunch of choir boys and everybody else around the world is a bunch of protectionists. That's what I think a lot of protectionists would like you to think, and they want you to. It distracts you from what they're doing, which is basically taking advantage of consumers. It's benefiting a very tiny group of people at the expense of everybody. And so this is just one of the methods that they use. You can look at China as an example. I went back and I looked at the fact of the matter is the average tariff rate in China back in the 90s was about 30%. Okay. Today it's about 2%. So China has figured out that moving in the direction of free trade has helped them. All right. This is one of the main reasons why China has been so successful over the past 25 years. Right. Now, China's average tariff rate, the other thing is last year on emerging economies, China lowered the average tariff rate. There is no average tariff rate. They went to zero with all the emerging economies. Okay. We're the ones that we attacked China. We raised tariffs on China and they responded, they retaliated. Okay. Again, I'm not in favor of that, but it was a reaction to what we did. The other thing is, I'll say that, ask two things. How many Chinese companies are in the United States? How many different retail chains and how many different restaurant chains do you see in the United States? Now go, and of course, you don't see any at all. Now go to China, and how many American chains do you see? Well, you see KFC, Pizza Hut. You see, they're all over the place. You've got Starbucks. Okay, all of that business, which is about $500 billion, does not is not included in the trade deficit. Okay, so this is another thing that everybody is missing. That American companies are doing quite well in China, and they've been allowed in with open arms. Now, why is it that we don't see? You look at electric vehicles. BYD just came out with a $9,000 EV, and it has autonomous driving. Why don't you see any EVs in the United States? Chinese EVs.
Huge tariffs, right?
30,
Same thing for solar panels too.
Yeah, why don't you see them in the United States? Well, under Trump, the tariff was 25%, and there are other reasons too. But Biden raised that to 100%. So basically, they've been locked out of this country.
When Elon was a Democrat, yeah.
Yeah, but they're it's the same thing. It's just the policies of Trump, the bad policies of Trump economically were just continued under Biden, and they were accelerated. So I think a lot of people thought Trump's trade war, oh, the Democrats were going to come in and they were going to cut this stuff back. No, they actually amped it up. And also they amped up the industrial policy with things like the CHIPS Act, which is another, you talk about, that's another kind of intervention in the whole free trade area. And this idea that you're going to bring back these these jobs. I have a venture capital contact in Arizona, and he was telling me that the problem, they're building all these factories as a result of the CHIPS Act, and Taiwan Semiconductor is coming in, and they're building advanced chips there, and this is going to create American jobs, et cetera, et cetera. Well, they've been having all kinds of problems finding talent, finding U.S. talent. And so they've had to ship in people from Taiwan. And so he said that, you just have all these restaurant chains. It's like a little Taiwan there. It's catering to all these immigrants that they're bringing in to take these jobs.
So then you piss off American citizens then because of the HBN1 visas, because these tech companies, like you said, they want to bring in the quality talent instead of spending years and millions of dollars training Americans to get those jobs.
It's all for show. I mean, it is protectionism at its worst. These jobs, the American taxpayer is going to be paying, like, I think I read somewhere, $6 million per job. And the jobs aren't even going to Americans. Look, as an economist, you just want to shake your head. None of it makes any sense. And like I said, the problem is we're at 122% of GDP in terms of debt. We've got interest payments going up. As you mentioned, interest rates have been stubbornly high, even though it looks like the markets are starting to sniff out a recession. And there's really no way out of this unless you have, if you're the Trump administration, you have to almost do everything perfectly from an economic standpoint. And so to do something, to follow this whole tariff strategy is obviously not moving in the right direction. It's moving in the wrong direction. And it's sad because I think a lot of the things that Trump has talked about do make a lot of sense. Cutting out government spending, cutting back regulations, all those things are positive, but unfortunately, they're being overwhelmed by all the negative things.
Yeah, I agree. And the history of tariffs and trade wars is not good for small businesses. It's not good for regular people and their standard of living. Now, I don't know if it creates inflation, but it could create shortages of specific goods. It could make it difficult to get a choice of different goods. And there's no guarantee that it's going to bring back the jobs, like you said, especially high-paying jobs. Could take years, if that.
No, I mean, the history of tariffs is really bad. It's really, really bad. I mean, and It's amazing that Donald Trump is a big fan of William McKinley. McKinley, of course, was a tariff guy, but so McKinley was assassinated in 1900, and and Teddy Roosevelt became president. And one of the first things he had to deal with was all the waste and fraud and abuse of the McKinley administration. So I just find it kind of ironic, that 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 Donald Trump is a fan of McKinley, but I have a suspicion Donald Trump, doesn't do a lot of reading when it comes to economics and history, especially financial history.
Well, I mean, if we had tariffs and they were small, say like 1 or 2% or something like that, and we weren't paying income taxes, or they cut like the corporate tax, the income tax, a lot of these taxes either enormously or down to zero, and we were only paying small tariffs. I mean, I don't think most people would complain, but then you would have to have a much, much smaller government. The problem I think you laid out earlier, Kevin, is that the government is just way too big. The interest payments on the debt, even if Doge was able to cut 500 billion or $1 trillion, they're not cutting fast enough that those interest payments on the debt, all that treasury debt that has to roll over. Do you think that that's why the gold price is at the levels that it is? Because the market sniffs out what this inflation problem, currency devaluation, they see what the treasury debt, that's why the interest rates are staying high. That's why the gold price is also been relatively on a rally, the last 6 or so months?
Yes, I think it's definitely sensing this, that we've got a problem, and all roads lead to money printing. I think that's definitely part of it. I think also the sanctions against Russia and the weaponization of the dollar, and that was a wake-up call for central banks around the world to accumulate gold. That's been obviously the first big driver of this move over the last couple of years. I think that's what drove it. I think it is kind of interesting that the retail investor in the U.S. is still not really all that interested. I know that the coin dealers, the spreads on coins are kind of historically low, and so there's really, I think the retail investor is more interested in the Magnificent Seven tech stocks than they are in buying gold,
Yep,
which is
and
pretty
Bitcoin and crypto.
remarkable.
Oh yeah, I 100% agree. They're also way more interested in Bitcoin and altcoins and meme coins. I mean, I see people complaining like my crypto won't come back. I'm gonna be broke. I have this large tax bill coming up soon from all my crypto trades, and now like my crypto trades are down. So I see those social media posts all the time. Like you said, I mean, people aren't looking that these gold companies. I mean, at $3,000 an ounce gold, some of these gold companies like there's going to be dividend growth, there's going to be free cash flow growth. They're just really out of favor. They're a contrarian value plays.
Yeah, and one of my rules is that if you have an uptrend and nobody seems to be all that interested, that it's probably going to keep going.
That's like the old Sir John Templeton quote, right? Bull markets are built on a point of maximum skepticism, right? They start there and then they climb the wall of worry.
Right, right. So I think, yeah, it's this is very interesting that you've got gold. This market this year, right? It's just the total opposite of everything that's happened over the last couple of years, where it's basically been all the action just in these large U.S. tech stocks
And
and the
Bitcoin.
S&P
Yeah.
500. And boy, if you were a stock picker, you're an active investor, or heaven forbid you were in emerging markets or China or Europe, you've just badly lagged behind. And then you look at what's going on this year, and it's been totally the opposite. So it's been kind of fun, actually.
Do you see stagflation then as kind of like the base case, the best case scenario given Trump's policies, the tariffs, if the tax cuts actually go through? Because I don't see Doge being able to cut spending fast enough. I still see government spending as a huge issue. Now, maybe cautiously optimistic Doge can do a dent in this, but I've seen some people say that Doge will only cause like a drop in the bucket for government spending cuts and that the debt problem is still going to grow very, very rapidly.
Yeah, well, I think something you mentioned earlier was just the resistance. And unfortunately, with the good things that Trump is doing, he's probably going to get resistance. And the bad things, of course, there is no resistance. So yeah, I think that's kind of a problem.
What do you mean by bad things? You mean like bad things as in like both parties in Congress, like when they say they're going to do tax cuts and cut government spending, they're going to increase the debt ceiling by another 4 trillion and sneak in a bunch of extra spending into bills?
Yeah, I mean, I just meant the tariffs. I don't see where Congress is going to get in the way of the tariffs. Um, and I so yeah.
Yeah, I mean the tax cut stuff, it's not getting passed because I guess like they're not agreeing to what trading votes. There's a ton of horse trading going on behind the scenes. It's a mess. I mean, Thomas Massey, I know you follow Thomas Massey's work. I mean, he wouldn't vote for the spending bill and Trump was calling him out. But I really respect Thomas Massey because he's been very consistent with all of his principles and the way he votes. And he was saying, look, Congress is trying to, they're claiming they're going to give you tax cuts and cut government spending with Doge, but they were trying to sneak in all this extra spending that the average person didn't see coming.
Yeah, and I'm absolutely a big fan of Thomas Massey. I mean, he's like today's Ron Paul. And I found it also very revealing and very troubling that Donald Trump singled him out because he was the only one who's standing up to what's going on. He called it out, and so Trump, of course, what does he do? He attacks the messenger, shoots the messenger, and he accused him of grandstanding, and then he also targeted him, wants him primary, which is apparently something Trump did in his first term. So, this is the whole point is that there are so many people that think that Donald Trump was going to just ride in on his white horse and save the day. And what I'm saying is Donald Trump is responsible for a lot of the problems we have. I'm not blaming it all on Donald Trump, but he definitely didn't do anything to help the situation. And so instead of riding in on the white horse, I think he's almost like more of a Trojan horse.
Well,
And
he's doing
so,
some good things with the Doge cutting and stuff, but he's also doing
yeah,
bad things with the tariffs. And I mean, he ran his first term, he ran $1 trillion budget deficit. And I think the gold price ended up a lot higher after his first 4 years. So he was running $1 trillion per year budget deficit. It sounds low now because we're at what, over $1 trillion per year now scheduled for just interest payments on the national debt. And I think right before Biden left, I think the budget deficit's around 3 trillion annualized.
yeah. The right now the budget deficit is about I think 1.8 trillion,
Oh,
and the
I don't believe the CBO numbers. That's the interest payments on the national debt, Kevin, were are slated for like 1.2 trillion.
right, yeah, they're right now they're like 1.15 trillion. But yeah, I know it's all on an unsustainable path, and Donald Trump has to uh, he's got to do everything perfectly. He's got to uh, run the gauntlet, thread
But
the needle, and stick the landing.
but he's
And
not going to because look, Congress said they won't vote. All the stuff's being blocked by the normal set of swamp creatures. I mean, even the Rhino Republicans, Mitch McConnell and those guys, they don't want a lot of Trump's agenda passed. But like the Democrats aren't even voting for stuff that they promised they would, with like no taxes on people's tips for restaurant workers. They're not even agreeing to that. So Congress is like intentionally blocking it here with the tax cuts. The whole thing is a mess. I mean, as an investor, Kevin, have you seen a period in time like this in the past in your career where there's all these crazy macro currents in the global economy? And which asset classes do you just want to play defense here, or do you want to go to cash? Would you play this? Be more defensive than normal?
well, absolutely, I want to be defensive, but look, I'm going to look at this, Jason, from like 40,000 feet. Like, what do I really think is going on? And and I've said this for a while. I'm a big believer in kind of identifying bubbles, but also bubbles create anti-bubbles. And there's a pattern to all of this. There is a false belief behind the bubble. And so if you start to put this all together, the first question is, well, what kind of a bubble is this that we actually see here? I think that this thing is massive. And I think it goes way, way back. So to me, it's about, and also another thing about the pattern of bubbles is that you get this long uptrend, right? And then you get the uptrend goes parabolic and it blows off in a wild frenzy, and the people that are rooting for it to, keep going. They suffer from hubris, and things get just totally wild, right? And then they crash. And then what you do is you take that long trend and you reverse it. You have a permanent reversal. So the question is, what is the bubble right now? What is the long trend? I think the long trend is the trend towards centralization in the United States of America. And I think that started in 1789 with the Constitution. I think there were many crises along the way where the trend could have reversed, but every single time that disaster, and I'm saying that in air quotes and facetiously, was averted. The big one, of course, was the Civil War, and it's interesting that we, as a result of the Civil War. Oh, and the Civil War also has tariffs involved in it. The Civil War was largely over tariffs.
Well, they also gave Congress the greenback, right? So Congress got to print the money, and inflation went almost hyperinflation for a small amount of time before they went back to a partial gold standard.
You just took the next words right out of my mouth. That's what I was going to say. Is that we got the experiment with the fiat currency. We got the suspension of habeas corpus and the violation of the Constitution. And the jailing of political dissenters, and you get all of this really bad stuff. And so what happens? You ask any establishment historian, and they're going to tell you that Abraham Lincoln was the best president that we've ever had. Okay, so it's been this long trend, and there have been many episodes along the way. The Civil War was one. That
1913, then like 50 years, 60 years later, Woodrow Wilson administration, look at all the damage that was done there with the Federal Reserve Bank Act, permanent income tax, World War I, a lost generation of American, all these things like during that. And then a couple decades later with FDR. So those were some of the worst, like the Civil War one you mentioned, Woodrow Wilson, 1913, that period of time. And then FDR, like those ones, just like every couple of years, Kevin, it's not every couple of years, every couple of decades. Yeah. It just like, it went up.
Jason, I'm gonna add one that I think is relevant, and that is 1898. That's when the United States really started on the path towards an empire. That's the Spanish-American War. I think the first invasion was Hawaii, and of course this was all under William McKinley, 1898. So, this whole idea of bigger government, centralized government, this long trend that we've been on, crossing over the Rubicon into building an empire. That was definitely 1898, and it was dramatic and it was sudden. And, this whole idea that sets the stage for, all these things are building blocks. And 1913, the infamous year of 1913, and with the income tax and with the Federal Reserve, all of this is setting the stage for our entry into World War I, which of course was a total disaster. And this took us, irreversibly on the path to empire. Then we get, we have the tariffs, the Smoot-Hawley tariff in 1930. That certainly paves the way for, what do you get from that? You get a very nationalistic reaction to it. And there were many factors in terms of what paved the way for Hitler. That was certainly one of them. And then you get this clashing of empires in World War II. And you have to remember that that Germany was the rising empire. You had the dying empire, the British Empire, and then you had the rising empires. And it was all about empire. And
well, the U.S. also put tariffs. Sorry to interrupt you, but the U.S. also put huge tariffs right on rubber and oil for Japan, right? So they felt like they had to potentially start invading China and then bombing Pearl Harbor, right, to try to retaliate against that. So those were kind of one would argue those were tariff driven too.
Absolutely, absolutely. But and you're right, and that's a great, very important point. And and so, but you have this, you have this giant clashing of empires in World War II, and we were victorious. We and the Soviet Union, right? Um, and so and then you had the Great Britain, which was victorious, but they were really the dying. They were handing over the mantle to the United States, and then you have this incredible event, which is the collapse of the Soviet Empire, right in the late '80s, early '90s, and so the United States now is the hegemon. Um, it's a unipolar world. And of course, we know that that's not a sustainable situation. That's a very incredibly rare. And that's the world that we've been living in. So, we should have gotten this wonderful peace dividend and all the rest of it. Instead, the military industrial complex, they didn't want to let go of this. And so they kept pushing and pushing and pushing. And once the Soviet empire disintegrated, and Russia is no longer really a military threat. Instead of disbanding NATO, what did they do? And this all happened under the Clinton administration. There were the senior military people who were saying, "Hey, shut this thing down. You don't want to be poking the bear, the Russian bear." And you had a bunch of young people in the Clinton administration who said, let's not listen to those old guys. Let's expand NATO." And so this whole wave of imperialism, and it really got going. It really had its kind of blow off period, I think, with 911, and and I think also, do you have you listened to Jeffrey Sachs at all, Jason?
No, but to add to your points there, I mean, like, not only that, well, NATO increasing also means military industrial complex would sell Europe more weapons, which means that there's an increase in defense spending with the world reserve currency. The US government in DC could bail out Boeing or Raytheon or any of those guys if they get into financial trouble. They just find a new war or a new proxy war or something like that. Look at Ukraine, like, magically, when the US was leaving Afghanistan, $9 trillion was spent in Iraq and Afghanistan, right? In the 20 something years we were there. When the US announced we were leaving, right? Magically, another war happens in Ukraine for 40 or 50. I think Thomas Massie pointed this out, that the military industrial complex was going to lose, I think, $50 billion a month in defense spending. And magically, another war happens to replace
Exactly.
it.
Yep. And so, this is what's happened. But at this point, and I think this, going back to the original idea of the bubble and this long trend, that what we're seeing here, I think it's a bubble in American exceptionalism. I think it's a bubble in imperialism, American imperialism. I think it's a bubble in this long trend of centralization, the state, the growth of the state. All these things are hitting the wall at the same time. So that's the bubble. And, getting back to how you want to navigate this as an investor, well, first of all, I want to avoid, anything that is really caught up in the bubble. I don't necessarily want to invest in defense stocks. I certainly don't want to invest in government bonds. I want to protect myself from the currency, because they're going to end up destroying the currency. And if that's gold, or if you want to speculate in Bitcoin, that's fine. I don't have an opinion there. I'm a gold investor. So, so part of being an investor and navigating through this is looking at that big picture from 40,000 feet, trying to avoid the damage of the bubble, and the bursting bubble, but also looking at the anti-bubble. And I know there's a lot of negative sentiment in this country about China, and I'm not a fan of any government. I'm not a fan of the Swiss government. Okay. And I'm certainly not a fan of the Chinese government. But I'm very much a fan of the people. I'm very much, and anybody who looks at the history of China has to be impressed with the people, their resilience, they're incredibly smart. They're incredibly hardworking, driven. And to me, China is the anti-bubble. To me, China is like the antidote of this aggressive imperial United States. You have this country that really wanted to dig themselves out of the depths of socialism under Mao and the poverty, the abject poverty that they were subjected to. And, the reforms under Deng Xiaoping in 1978, and, just incredible progress since that time. So China, to me, is really the anti-bubble. And, the beauty of this is, number one, like if you're looking for opportunities, what are you looking, what creates a great opportunity? Well, if it's hated, it's cheap, and it's fundamentally sound or at least improving. And I think China is one of these, it checks all three of these boxes. You look at how there's just so much going on there, and it's so hated. I think the reason why it's hated is because it's been successful. I looked at, I'll give you a statistic. A lot of this goes, we can look back at 2000 and what's happened in this country, in the United States, going down the wrong path. I think there have been, three events. One was 9/11, and our reaction to these is a combination of 9/11 and the bursting tech bubble. We responded to it with printing money. And then you had the GFC. We responded to that with printing money. And COVID, we responded with printing money. And that's how essentially we got into this mess. And we also responded by being very aggressive militarily around the world. Okay. You look at China in 2000, their GDP was less than 12% of the US GDP. Today, it's 63%. That, in a nutshell, explains why China is hated. All the hatred, not all of it, but a lot of the hatred is coming from the military-industrial complex.
Well,
Okay?
I think a lot of American workers are upset that it's difficult for a lot of companies to start and new jobs to be created here in the United States. So there were some jobs that were created, but a lot of them are not high paying that left, like the manufacturing jobs. So like our manufacturing base was hollowed out, and those jobs were not replaced with as many higher paying jobs.
It's a scapegoat, though. I look at it very differently. Obviously, look, change happens. Change always happens, and you're always going to have people displaced. We've got this AI wave going on right now. Guess what? It's going to destroy jobs. Farming, it used to be that that farming was 99% of the jobs in the United States. Today, it's 1%. Okay, it's the destruction of jobs that is good for an economy. So I don't see.
So you're saying we shouldn't blame China then? That honestly, I would blame the lack of job creation and high-paying jobs. I think it's on rules, regulations, tax policies, those types of things. They make it very difficult for a lot of small businesses and entrepreneurs to build a factory and start scaling it up here in the United States. I mean, I've heard Elon Musk talk about this. Like he said, he was basically forced out of California with a lot of their manufacturing and other stuff. So it sounds like it's just very, very difficult. You mentioned the example with Taiwan Semiconductor in Arizona. It's just very difficult for a company to do what they did, say, 50 or 100 years ago in the United States, to invest here and start scaling up and building manufacturing base again.
Yeah, I think that's part of it. Absolutely. But another part of it is just the fact that China has, every year they graduate 4 times as many STEM students as we do. They just have the numbers. They have the infrastructure. We've been spending money on weapons, and they've been spending money on infrastructure. Infrastructure is important for building supply chains. It's just been a matter of there's a lot of different factors. But what I will say is that look, we've been printing a lot of money since 2000, and that we have, what's helped this situation is the fact that we've got the reserve currency status, and that foreigners have been sopping up a lot of these dollars. The other thing that's helped has been the the rise of China, the productivity of China, the fact that China has become the world's factory, and that it's keeping a lid, that we're basically importing deflation from China. So, you have to ask yourself, why is the rise of China, a country this size that is becoming so much more productive, why is this a negative thing? If trade is win-win, and somebody look, if your neighbor, let's just say your neighbor becomes very wealthy for some reason. They land a good job and they start making lots of money and everything. I've seen it in my own neighborhood. And what happens is, does the fact that your neighbor now has become much wealthier, have you become poorer? No. In fact, what happens is your neighbor now is employing all the neighborhood kids, okay? Because he's got work that needs to be done. He's
It
too busy making money. He's got work that needs to be done. He's got something to trade with everybody else. Everybody else is being lifted up by this.
Well, but it
So,
becomes different with countries involved that have standing militaries and a military industrial complex, and they want to, start a conflict and have weapons to sell and use weapons, and they profit from someone else firing bullets or firing missiles, using planes and tanks and guns and stuff.
well, you just described our country. And
Well, it's throughout history. I mean, every time there's like one clear empire, right, and an upstart empire. So I mean, it's happened countless times throughout history.
well, but you see, you said upstart empire. They have no imperial aspirations, at least not now. Now that may change in 100 or 200 or 300 years, but there there are no imperial aspirations. I saw a piece that BCA Research put out. My friend Marco Popic, and the neighbors of Thailand, I think it was Thailand and maybe Indonesia. He showed defense spending as a percentage of GDP in those countries. It's gone down dramatically, and so if China's not a military threat because its neighbors, they don't seem to be that concerned. So no, it's just the rise of China has been a good thing unless you are the military industrial complex because it threatens your racket. Okay. So what you have here is, I think, China becomes a scapegoat. It is the perfect scapegoat for what is going wrong in this country. And, you've got the military industrial complex, is fomenting a lot of this animosity. And it also becomes a convenient scapegoat for people that have lost jobs in let's say, in manufacturing. It's easy because it's half a world away. Hardly any Americans have been there, and it all fits on a bumper sticker. But that's not what is causing the problems. And in fact, if anything, and this is an argument I've been making, is that the rise of China has helped American living standards greatly. And if we really want to shoot ourselves in the foot and we really want to go into a depression, try decoupling from China.
Yeah, I just see a giant mess ahead. It's going to be a messy divorce. I mean, we're in a trade war
Well,
now, so I see
it's
both sides now escalating, unfortunately.
it's not going to be a divorce. Okay, I can tell you that right now. It is not going to be a divorce. Okay, a divorce or a decoupling or onshoring or all this. These are all mercantilist fantasies. Okay, in the real world, this is not going to happen. It just won't.
Well, or we see factories in Mexico. They don't actually come back to the United States. We see the factories. So like Apple Computer then, or some of the other manufacturers, then they start moving more of the factories to Mexico then and importing through NAFTA. So we're going to probably see more of that.
No, you're going to see what you've already seen is, different. You've got different industries that are going to have different levels of impact from all this. You got to keep in mind that China has been moving up the value chain. So a lot of for example, apparel would be, low end manufacturing. Um, the Gap, the CEO of the Gap was interviewed by Yahoo Finance the other day. He said that just 10% of the product comes from China, and only 1% comes from Mexico and Canada. So what's happened is China, they, in trying to lift their people up, they were willing, it was kind of a trade-off because with that low-end manufacturing came a lot of pollution, and it created some major problems, health problems, all kinds of problems for the Chinese. And so they've been moving up the value chain and have allowed that low-end manufacturing to move to, Vietnam and Indonesia and countries like that. So I think that, an interesting area right now that might even be worth looking at for investors is apparel, because I don't see where apparel is going to be really impacted very much from these trade wars. But when it comes to high-end manufacturing, like an Apple iPhone, that's a totally different situation.
So far, no extra tariffs on something like cotton or anything like that. Oh, thankfully. Although I just saw there's a huge tariff now, I think, on copper and some American aluminum and steel. I think I just saw those, and there was an executive order last night out of the White House. I think Trump just announced that one of the senior executives, or the former CEO of Newmont Mining, he's going to be in charge of fast tracking all these mining company projects here in the United States, like uranium and copper, and then uranium enrichment and other stuff too.
Yeah, we'll see. But it doesn't sound to me, when I hear things like fast tracking, I don't hear a lot of free market. I don't hear a lot of let's just let's just get out of the way.
Well,
Let's
the Environmental Protection Agency, all those. See, here's the point, Kevin. Like, I hear these Democrats and a lot of these people say, like, what the Republicans are doing, cutting government, is unconstitutional. All these government agencies, what the Federal Reserve Bank, the IRS, all these government agencies are unconstitutional. They never should have been put in place in the
Yeah.
first place. The Constitution never even mentioned it. They put in so much rules, regulation, red tape. The economy can't adapt it all and add new jobs or adapt to any types of changing market conditions.
Yeah, no, I agree. And so anything they can do to get rid of the red tape. But yeah, the problem is that it's like you got the good Trump and the bad Trump, and we'll see how it all plays out. Right now, I just don't think, I think the markets are starting to get a sense for the problems, but I mean, it just seems to me like the complacency level. You still have the VIX under 20. You still have there's been plenty of dip buying by retail investors. Fund flows into U.S. equities have been positive, and they've actually been negative with international equities this year. So I think we're still early in all this, and it's maybe, Jason, maybe what has to happen is that we have to feel some pain, maybe a lot of pain, and that we'll eventually. That's what's going to look. It isn't going to be Congress that stops Trump from doing the tariffs, but maybe it'll be the stock market, and maybe it'll be the court of public opinion.
Well, right now it's Congress. Congress, because those tax cuts, honestly, I think he thought that the tax cuts would be passed first and then the tariffs would come on. And he thought that the tax cuts getting done first would be like a cushion for the tariffs. But since the tax cuts are not in place, I think the market's going to get really pissed at that, because you're seeing that with the earnings, right, coming out saying the tariffs are impacting the S&P 500 companies. They're causing higher costs. They're causing inflation. They're missing earnings guidance. So that's pissing off Wall Street. And so, like, Trump is also he's already talked about, potentially freezing the tariffs for a temporary period of time. I'm not a fan of these things in trade wars. I'm just saying, what's happening. But the Chinese companies that you talked about, now, do you want to talk some of the stock picks? Because you've talked in the past, I think, positively. What about
Yeah, look,
Alibaba,
I
Alibaba
think you
and
know what,
JD.com?
Jason. I mean, we've talked for about an hour. I'm not sure I really want to get into too much more. I mean, maybe we should just kind of wrap things up a little bit here,
Sure.
not drag. I mean, it's your podcast, but I'm kind of feeling like it's a Friday, it's late, and I think I'm getting a little exhausted.
Yeah, I hear you. So for our listeners out there, Kevin, in the newsletter, do you mind if I mention one or two of your stock picks in for your newsletter that you've talked about in the past, the Chinese companies?
Yeah, that's fine.
Yeah, so you've talked positively, I think, about Alibaba, that there's value there and there's growth, that is potentially the next Amazon with some of the things that they're doing. And then I think the other one that you liked was JD.com that was mentioned in past newsletters.
Yeah, so actually, I will say that I've recommended KWeb, which is the Crane Shares Internet ETF, China ETF. Um, my so the thing that is interesting about investing in China is that there are a lot of ways to do it. Okay, um, KWeb is an easy way. You get, I'm looking for exposure to the consumer. My feeling is that the rising tide, basically consumption will do well over time in China, expanding middle class and so I think the big movers so far this year have been more the tech companies. That was largely a result of the DeepSeek news and this realization that the Chinese technology is much further advanced, I think, than most people gave them credit. Those have been the big leaders so far. Personally, I wouldn't chase. Alibaba has been a huge winner so far, um, and I don't think I would be necessarily chasing those as much right now. But I think some of the consumer related stocks have lagged behind. They've done well too, but they're much more reasonable. So that would be my advice. The other thing is that if you don't feel comfortable investing in China, there are plenty of companies that do business in China that are American companies or European or Canadian, and so that might be worth a look. Um, I can. I'll just give you an example of one. Lululemon, they got into China, I think, about 10 years ago, and they've been very successful. I think they get about, off the top of my head, I think about maybe 10%, 15, maybe it's 15% of their revenue from China
Well,
now. And
Lululemon's technically Canadian. I think they're out of
yeah,
Vancouver, but
yeah, they're Canadian.
the founder though, Kevin, actually like used to put Ayn Rand quotes on the bag, but then they kicked him out because he made a woke comment.
Doesn't surprise me. Yeah. Yeah, so there's lots of ways to invest directly or indirectly in China. Um,
As we wrap up here, just your thoughts on some of the gold stocks, commodities are really out of favor. I mean, copper's at $5 a pound. The uranium stocks have had kind of a huge correction here. Energy, like the normal energy plays, like oil companies, are really out of favor. I see just absolutely. I think this is the worst negative bearish sentiment for oil since 2020 when the oil prices got down to 20 or $30 a barrel. We're at what, in the mid 60s right now, so it's kind of ridiculous given where the price is and sentiment. Do you see value here for some of these types of companies?
yeah, I definitely like energy, and not going to get into specifics, but I think the flows, the ETF flows, have been negative on the major energy ETFs for something like the last 8 months in a row. So
Yeah, it's
definitely.
shocking. It's to my oil hedge fund manager friend sent me some sentiment. We're at pandemic 2020 levels. It's shocking.
Yeah, yeah. So that's what you want to see. The the businesses are in good shape, and definitely the whole underinvestment theme in commodities and energy, like that. I think also an expanding middle class in China is probably good for future demand. So yeah, definitely like the energy area. We've been, we continue to like gold and the gold mining stocks. I have been. I know they've had big run-ups, but you almost have to go back and you just keep putting in the new number in terms of gold and look at those cash flows and say, geez, these stocks are really not all that expensive. They've
Well,
they've.
Well, a few of the gold miners have had a run up, like Franco Nevada, Agnico Eagle, a few of the others. Most of them actually haven't moved that much yet. I think the GDX, that's the gold miners ETF, it still was around 45 yesterday. That's still
Yeah,
way off the 2011 highs of like 65 when the gold price back then in 2011 was 2000.
yeah. I think if GDX, you have to have an opinion on Newmont and Barrick. Those are two that fortunately we haven't owned, so that's really helped our performance there. But I don't really have a really strong opinion there. I actually have benefited quite a bit from Fred Hickey. I mean, he's been spot on with the gold mining stocks. I have to give him a lot of credit.
Oh yeah, he likes Alamos Gold. He's been a huge proponent. I think he said that Alamos Gold is his favorite gold stock for years now.
Yeah, yeah. We that's one that we own.
Well, they got lucky. One of the miners right next to one of their producing mines had a huge problem building a mine, and that extra asset just fell right into their lap, which is like unfortunately happens all the time with the gold mining industry.
I'd rather be lucky than smart.
Well, if you have cash, I mean, like it's a buyer's market, right? So if you're a little company and you have to bet the whole company on one mine, there's a lot of things that could go wrong, even at the gold price at these levels. And then if you have cash, you can go in and buy those assets for cheap.
Yep, that's right.
Well, I want to thank you so much for your time today, Kevin. I think you've given my listeners a lot to think about. Like, I know there's people out there that just trust everything Trump is doing, but, history with these tariffs and the trade wars, it just says otherwise. Now, I am rooting for him to cut government spending. God knows I see it every day here. I've been warning people about this for the last 15 or 20 years. All the waste, fraud, corruption, and abuse here. I hope they are successful cutting the government spending. I just don't know how much of a dent it's going to do because things were that bad the last for decades now.
I'm rooting for it too, but this is the same president that oversaw a 20% increase in spending in one year. And so we just have to hold his feet to the fire. And when he does dumb things like implement tariffs, we've got to say something about it. So yeah, I hope for the best, but prepare for the worst.
And I will attach links to Kevin's newsletter, The Coffee Can Portfolio. It's a very inexpensive newsletter covering contrarian value of ideas, basically profitable companies that can grow cash flow and dividends that are out of favor right now. Kevin talked about China, but also commodities. It's going to be a tough defensive environment here. Staying away from those U.S. Treasury bonds because it looks like yield curve control and financial repression are best case scenarios going forward.
Right.